Hi everyone, welcome along to the Squirrel Investor webinar. My opportunity to chat with you for about 20 minutes on some topics that I've picked, and then we'll move into Q&A and you can start to ask me some questions. Before we get started, better talk through the disclosure statement. I'll let you read that when we post this on YouTube, which will be in about a week's time, so you can go back and have a good scan through that if you wish. We are recording today's session and we'll post a copy of that, as I said, on YouTube in about a week's time. We will cut the Q&As from this morning's session and add them to this session, so you can come back and watch all of this again and see the questions that were asked for different people, or by different people. Rightio. Today's agenda, first of all, we're starting off with interest rates. We're going to have a bit of a crystal ball gaze at what I expect to happen over the next wee while. We'll then spend some time on the construction sector. Obviously, we lend into the construction sector, so we'll talk a bit in a bit deeper way about what we see going on in different places. We'll then relate that back to reserve fund performance with a bit of a focus on the construction loan term investments, and then move into Q&As. If you have feedback on today's session, don't be afraid to let me know on dave@squirrel.co.nz. Righto, interest rates. OCR announcement tomorrow, and then another one on the 26th of November. The market is expecting that we're going to get a cut tomorrow and then another cut in November. The question is, will it be 50 points or 25 points tomorrow? OCR is currently 3%, so that would bring it down to either 2.75 or 2.5. I'll let you take your pick. The economists are fairly evenly divided one way or another. My view, if it was up to me, Reserve Bank Governor right now, I'd probably be going 50. We know at the last OCR announcement that 2 of the members of the board actually voted for 50 points at that point. They only cut 25. I suspect those people might be wishing that they'd cut 50, or those that didn't vote for it should have cut 50 at that point. One other observation is that we see the deposit to compensation scheme, which arrived in July this year. Non-bank retail deposit rates have come down relative to where bank deposit rates are. We've seen more money flood in their direction, mostly out of banks, and as a consequence of that, we've seen an increase in non-bank lending competition, some of which are markets that Squirrel looks to lend into. Competition, we're all for that, so happy days. Moving on, last point, given the reductions in interest rates that are expected, we expect that Squirrel will be cutting our investment and borrower interest rates, remembering that the bulk of our investments are on floating rates, as are our borrower floating rates. So we'll be moving down a little further between now and Christmas would be our expectation. I'll just talk briefly to the chart on the right-hand side. So it's a 6-month bank term investment rate. Our expectation is that you're going to see 6-month bank term investments sitting around 3% by the time we get to Christmas. And if not by Christmas, not long, perhaps once we get to February. So that's our expectation. Beyond that, hard to forecast at the moment. Will the OCR drop beyond sort of 75 points? Hard to say. It's going to be data dependent. And we do know that the inflation rate's still holding up at around 3% at present, despite the fact that the economy is feeling pretty gloomy. All right, enough on interest rates. Starting to think about the construction sector. So we work a lot with a company by the name of CreditWorks, who have some fantastic reporting on how different companies are going, with a big focus on the construction sector. So they have a really good insight to see what's going on. Our view would be over the last 6 months that the sector's been particularly slow. No surprises there with the headlines that you may have seen with some construction companies going bust or liquidating. However, we do think we're near the bottom of the cycle. So the graph on the right-hand side is from CreditWorks, and they're looking at the number of filled construction jobs versus job listings. So blue line is the filled construction jobs. You can see that's kind of dropped from its peak, starting to stabilize. Equally, the listings for new jobs have started to stabilize, albeit at very low levels. So, there's no massive recovery happening between now and Christmas. I don't think anyone is naive enough to think that. So we think we're nearing the bottom of the cycle. Capital is starting to recycle. So we're seeing developers who have been sitting on unsold properties starting to sell them, and that's recycling capital into new projects. So developers are out buying new pieces of land and new properties to look to keep that cycle moving. So we are starting to see that capital recycling after a very slow period of capital taking a long time to recycle out of projects. Typically, employment is the last thing you tend to see turn in a cycle. So I think we're at the bottom. We'll be keeping an eye on those construction employment numbers, which will give us a sense of whether things are starting to improve a little. Another observation would be during this market correction we've seen over the last 2 to 3 years, the best developers who understand their market and what they're building for best have done the best. So they've continued to perform if they know what to build in the areas that they're building in. They listen to the market and are building to that. They have been successful. Those developers who have simply banged up 3 or 4 townhouses that haven't paid any attention to the type of townhouse they're building and what buyers in that particular neighborhood are looking at, they're the ones who have struggled to sell those properties the most. So better quality developers who pay more attention to their market and develop their housing products to suit that market have done best. Really interesting graph on the right-hand side. Let me talk to that first. So what you see here is the amount of purchasing activity going on in the residential construction sector and the divergence that you can see between the North Island and the South Island. We know that the rural sector is going well. We've seen, obviously milk prices very high, red meat prices have been strong, and horticulture's been strong, particularly kiwi fruit. Although apples, I also hear, have been going pretty well this season. So South Island has performed way, way better. They've had flat to slightly rising volume of purchasing going on compared to the North Island, which looks like it's still heading down. Our view, perhaps after Christmas, we'll start seeing the North Island flatten out. And during the course of next year, there are signs that things will start to improve. I talked about that capital recycling out of projects and developers now buying at better prices with opportunities to build quality product in the market, starting at different points next year, or at least getting into the consenting cycle for stuff to be built in 2027. What's been built in the construction sector? So using data from Stats New Zealand, medium density housing is around 50% of new builds now. The remaining 50% is made up of single house builds and apartments. For single house builds, the average size of single houses has dropped over the last 10 years from about 210 square meters to 175 square meters. There's actually quite a large drop when you work through, just how big an area that is. So typically smaller pieces of land and smaller houses going onto them. Perhaps more and better creative use of the space that is available there as well. For medium density properties, so an example of medium density is what you see in the picture to the right. Those houses are stable at about 110 square meters on average over that same 10-year period. Building consent volume peaked at the top of the property cycle at about 4,500 per month. It's fallen back to about 2,800 a month, but stable at that level. We know not every single consent that gets issued results in something being built, but the fact that it's stabilized at that 2,800 level suggests that we're not going to get worse, and if anything, things may start to improve during the course of next year. Another obvious trend has been that renovation activity has continued to slow. So it's been on a downward trajectory for a number of years now, and no sign of that plateauing just yet. So if you know builders who have been struggling to find work, that's the other reason. It's not just the new builds, it's also that renovation activity. People are tending to hold on to that money in their pockets, make sure they're stable before they commit to decisions like a renovation. Here's what we see on the finance side of the construction sector. So in the market, talking through what we see in the market at this point, first of all, Um, Loans that were made to get the consenting process underway in kind of late 2021 and into 2022, those developments have largely completed now. If you think about a consenting process that can take 9 to 12 months, and then a build process that takes, anywhere from 6 to 18 months on top of that, those properties were finished in 2024, and that capital is starting to recycle into new projects now. So most of the purchases that were made when house prices were at their peak have flowed through. Either the builder or developer has sold what they were sitting on and cut their losses, or they've gone through their development and managed to get through it. There's still a bit of pain out there. We see some developers, not necessarily ones that we've lent to, but certainly at a market level, who are struggling to sell stuff that they've developed. Um, Always a bit dangerous with anecdotal examples. There's a four townhouse development very near to where I live. Uh, they are down to one left to sell, but that's taken them more than 12 months. They've been on the market that long. So took about 6 months for the first one to sell, and then they've sold another one about 3 months later, another one 3 months later, and here we are a year gone, and they've still got one unit to sell. Talked about the capital recycling to a new project. So how does that work? So that means when a developer sells a new sells something that they've built, a house that they've built, uh, once they get paid for that, that gives them capital back, which allows them to then commit to the next development at that point. We have seen lower quality developers being weeded out, those that perhaps thought there was lots of money to be made and dived in without necessarily as much planning as they might have hoped for. They've been burnt and they've started to be weeded out during the course of the cycle. Higher quality developers have been operating on smaller margins, but they're making hard decisions to keep themselves moving and keep that capital recycling. So yeah, those higher quality developers, they've found ways to keep moving, despite the fact that we've had a pretty rough market over the last 2 to 3 years. From a Squirrel perspective, if we look at our own loan book, we've got a handful of longer running over-term loans. The end is in sight for those between now and Christmas. We have one potential mortgagee sale in the works. That loan is reserve fund protected. If a loss happens to occur, assuming that we go ahead with the mortgagee sale, which isn't certain at this point, the owner of the property still has the opportunity to sell prior to us commencing that mortgagee sale process. There are no others on the horizon at this point. Developers are securing properties at better prices now. So the newer deals that we're seeing come through, developers look like they're buying successfully at pretty good prices, which looks like they'll be able to deliver pretty good outcomes into the market sort of 12 to 24 months from now, when those properties have been through the consenting cycle, been through the construction cycle, and they come out the other end. The expectation is that they will probably see their margins starting to grow again through that period. Last but not least, Squirrel ourselves, we've seen slower settlements of new loans during September and into early October. Looking ahead at our pipeline, we're starting to see an increase in the volume of settlements that we expect after that pretty slow September in the scheme of things. So still activity out there, things are still cranking, but we have had a slightly slower patch in recent times. From an investor perspective, that means those term investment order queues have been longer than what you are normally used to seeing. That's the combination of less settlements, but we've also seen continued growth of money into Squirrel seeking investments in what we offer. Really important to note that despite there being lots of money in those queues, we don't change our lending standards. We know that that's going to be a recipe for disaster if we were to do that. If we were to lower our standards or lower our pricing and see more business come in, that might not be as desirable. That will impact us 12 to 24 months from now. We're not keen on doing that. So our lending standards are maintained as they were. Righto. Moving on to how the reserve funds work. So let's talk through what goes on and how a reserve fund earns money to begin with, which is the table on the right-hand side there. So to begin with, we call it the waterfall. You start with a borrower interest rate of 8.55%. This is I guess, an average in our portfolio at the moment for a construction loan. Let's assume that the monthly repayment that the borrower needs to make is $10,000. The average reserve levy that we're charging in our construction portfolio today, 0.65%, which is going to earn the reserve fund $760 for each month that payment is made. Squirrel's margin is about 1.65%. That means Squirrel will earn about $1,900 each month off the back of that loan, which is obviously our margin and our revenue to keep doing what we do and sourcing loans and supporting those loans and providing all of the technology that underpins what we do for investors. Last but not least is the investor return, currently 6.25% on a construction loan term investment. So investors are earning $7,300. So if you take that $10,000 that the borrower's paid, you can see how it's carved up between the reserve levy, Squirrel's margin, and investor returns. So the reserve fund steps in a situation where a borrower misses a payment. So borrower misses payment, the reserve fund steps in and makes that payment. So in our example on the right-hand side, let's say the borrower dishonors their loan payment, reserve fund makes that $10,000 payment, which is split up across the reserve levy, the Squirrel margin, and investor returns. And then that means a debt has now been created between the reserve fund and the borrower. So when the borrower catches up on that payment, at that point, the reserve fund gets refunded the money that it's paid out. The second example is a loss when a loan is written off. So if I give you an example, so let's say it's $1 million property, we've lent our maximum of 80% loan to value ratio, which is an $800,000 loan. The borrower goes bad for whatever reason. We end up writing off that loan, taking the property to mortgagee sale. We sell it at mortgagee sale, and let's assume that property prices are off 30%, which means we return $700,000 from an $800,000 loan that we wrote. The $100,000 difference, that's where the reserve fund steps in to act as that shock absorber for investors. So that means that investors would continue to earn all of their return and have all of their capital repaid in that situation. Reserve funds are not guaranteed. So we don't guarantee the reserve fund's always going to have enough money to do what it says it needs to do. To help manage that, Squirrel, the manager, can call active management. So what that means is that we can reduce the investor return in order to boost the amount going into the reserve funds, to make sure that reserve funds always have enough capital to manage things as we go. That investor return could go to zero in an extreme situation. I'll talk about a bit more about that in just a moment. Last thing is reserves are held in trust for the benefit of active investors. So the money in those reserve funds is not Squirrel's money. It's held in Squirrel peer-to-peer trustees, so in trust or on trust for active investors at the time. No single investor has access to those funds. The only time they're activated is if a borrower misses a payment or we write off a loan and a loss has taken place. The money in the reserve funds is held in bank accounts with a major New Zealand bank. They earn interest, and that interest is paid back into the reserve fund. So that helps contribute to the inflows for the reserve fund each month. Let's take a look at the construction loan reserve fund now. So the graph on the right shows our construction loan reserve fund started with $100,000. So it was seeded by Squirrel with $100,000. And you can see that it's reached almost $4 million over that 5 and a bit year period. Should cross 4 million during the course of October. The average growth that we've seen in that reserve fund since January this year is about 135,000 per month. To date, the construction loan reserve fund has suffered 2 losses. So one, you can see indicated where the graph dips down in December 2022, January 23, around that area. And the second loss, which occurred in about August 2024. The other item on that graph you can see is the star there. So if you recall back to the property cycle, we saw property prices tip over the edge late 2021, early 2022. At that point, Squirrel expected that there could be more stress in the portfolio. At that point, we lifted borrower interest rates and left investor rates where they were, which lifted reserving by about 25 basis points or 0.25% at that point to increase the rate of reserving. That took our average reserving up to around 0.90%, and then we've slowly backed that off over the last 6 to 12 months. As we've seen the reserve fund performing well, the property market going through its cycle and starting to stabilise. And we've done that through a combination of holding investor rates up at times and bringing borrower rates down a little. So there's a bit of movement on both sides of borrower and investor to see that reserving come down to that 0.65%. You will have noticed at the last OCR announcement, Squirrel did not move its interest rates, as an example, on the investor side. The other thing about our reserve funds, we also measure the expected credit loss. So we expect a really bad scenario. That's what we plan for. And that's why we reserve at 0.65% when the actual experience loss rate today is 0.06%. So we're reserving at about 10 times the experience loss, and we're reserving ahead of what the expected credit loss is. And when I say expected credit loss, that assumes property prices drop 30%, we have lots of write-offs in the portfolio, etc. So if I look at the total balance in the reserve fund today, it's got about 2 times the expected credit losses in the portfolio that are in there. So we're deliberately conservative about how we plan for stuff that could go wrong. All right, so there's a bit of a tutu through the construction loan reserve fund. Overall, it's performing well. $4 million goes a long way to manage losses should any losses come through. As I've said, we plan for losses. We expect that they will happen from time to time. We've had 2 events occur in the 5.5 or 6 years that we've been lending on construction loans. For comparison, in our home loan portfolio, to date, there's about just over $500,000 in the reserve fund. We've not experienced any defaults in that home loan portfolio. So just for comparison purposes, our home loan portfolio is a lower risk investment. And I think sort of 5.5 to 6 years in, we've not seen any defaults in that portfolio. So good performance there. And as I said, just 2 that we've seen that have been supported by the construction loan reserve fund. Reminder that all of the investments that you make in either our term investments or our monthly income fund are supported by one of our reserve funds. So that's in place there to support investors and act as that shock absorber. Moving on now to Q&A. So how have I gone? We've used just over 20 minutes, so that was about right. Time for Q&A. I can see that there were some questions that were being asked in there already. Let's pull those up and I'll get into them. So first question here from Terry. Is the current investment rate that investments were lodged at remain the same, irrespective of what changes there are to the OCR, and consequently the onward rates offered by Squirrel? So for our home loan and construction loan term investments, and for our monthly income fund, they're effectively all variable rates. So even if you've locked in, if you've invested today in a home loan or a construction loan term investment, that rate can go up and down during the course of your investment, Terry. So I think we clearly state that everywhere that it's a variable rate term investment. And for those that have been investing with us for a while, I think if you go back to when interest rates were 0 during COVID, our home loans were paying 4%, construction loans 5%. They rose to 7 and 7.5% respectively at the top of the interest rate cycle. Today, 5.75 and 6.25. If I gaze into my crystal ball, what might happen over the next wee while, my expectation is by the time we get to Christmas, we could see that home loan rate down in the low 5s area. Construction loans, perhaps in the mid to high 5s, somewhere in that zone. So that would be my expectation, Terry. Clearly gazing into the crystal ball, though. Thank you for that question. Question is, what might happen to the OCR during the course of next year? So during the slide that I talked to earlier, I mentioned that we expect OCR to fall probably twice by Christmas. After that, harder to say. We're probably getting towards the bottom of the interest rate cycle at that point. If there is another cut, and the market is pricing in the possibility of one more cut post-Christmas, then you'd expect rates to probably be pretty flat most of next year. And pretty hard to tell how quickly we're going to come out of this recession that we're currently in. So, yeah, my expectation would be rates will be pretty flat once we get into kind of the end of the first quarter next year. What does softer settlements mean? Okay, so softer settlements is the volume of loans that Squirrel is settling. So softer means we settled less during September. So that was my comment related to what we settled during the month of September. We saw the lowest settlements that we'd had, I think, all calendar year. And just a bit of a quirk there, I think those settlement volumes will pick back up during the course of October based on what our pipeline looks like. And they look reasonable out towards the end of the calendar year. Hard to look much beyond that at this point. So that's what's going on there, Terry. And I think my comment was primarily about the time that it's taking to get invested. So during September, we saw pretty strong inflows from investors wanting to get invested, and it happened to coincide with a softer period of settlements, of loan settlements coming through. Thanks, Terry. Question from Henry. Does the reserve fund earn interest, and is that an ongoing contributor to its growth? Yes, is the answer, Henry. So the reserve fund's sitting in bank accounts. Those bank accounts earn interest and they contribute in. The rates obviously aren't high. Our determination at this point is we want to keep the money very liquid and just in bank accounts. There is no intention to do anything else other than invest in bank savings accounts, call accounts, or term investments. It would not make sense for us to go and invest that in anything with any risk, because the whole goal of having a reserve fund is that it's there when the dark times arrive. Thanks, Henry. Hope that answers your question for you. All right, next question from Joyce. At the moment, there's still strong demand for construction loans. In simple terms, Joyce, yes, there's definitely still demand out in the market. I talked about quality developers still managing to progress the work that they're doing, and new deals being done, new settlements happening all the time. I guess one observation is about a quarter of our construction portfolio is based in the South Island and mostly Christchurch and a bit in Queenstown. So those two markets continuing to see stronger demand than what we see in other parts of the country. And yeah, so if you look at our lending, we lend right throughout New Zealand. In the South Island, if I recall at the moment, we've got stuff going on in Nelson, Christchurch, Queenstown, Dunedin, and Invercargill. So yeah, a good, nice geographic diverse mix there. Auckland clearly has been softer, and even Tauranga has really softened. We've noticed during the course of this year. So we're seeing less development activity going on in Tauranga. This is Squirrel specifically. But yeah, other parts of the country going along okay. Thanks, Joyce. Next question from Jessica. I think just a comment back to Terry's question around trying to hold the term investment rates up. So yeah, I agree. Good try. Unfortunately, no, they're variable rate products. I guess one thing that we aim to do is we aim to deliver a return that's sort of 1.5% to 2% higher than a bank 1-year term investment rate. Okay, so kind of we're gauging ourselves back to banks in some respects as far as the rates that we go. Question from Joyce. As an investor, should I still pump funds into the construction loan sector? Well, I guess each investor is different, Joyce. We still see good opportunity to lend to quality developers in that space. You can see how our portfolio has been performing. So I think there's still good opportunity for investors to earn good risk-adjusted returns with those reserve funds in place for investors' choice, but each individual investor will need to make their own decisions around risk. If you want to lower your risk profile, from a Squirrel perspective, our home loan portfolio is significantly lower risk. There's, I think, an average loan to value ratio on that portfolio of mid 50s, which is pretty low and offers good risk weighted returns, would be my view. So, um, yeah, home loans, lowest risk, construction loans, a little bit more risk. The monthly income fund for those that invest via the fund is a blend of both of those things. Typically, that blend 25% home loans, 75% construction loans. It does move up and down a little over time as far as that blend goes, depending on what's going on in the market, but that gives you an idea. Thanks, Joyce. Question from Henry. More complex question. All right, I'll steel myself for this one. If I need to sell an investment quickly through the secondary market, uh, is there a chance it could take longer if the loan has had a credit event related to it? So the answer is yes to that. So let me explain in a bit more detail. If a loan that you're invested in via a term investment has had a credit event, so we determine a credit event to be A, it's missed a loan payment, um, or B is over term. So that means it was expected to be paid back by a certain date, but hasn't yet been repaid. Both of those things constitute a credit event, and that means when they go to the secondary market, if you're going to sell them, um, it means that we give the investors who are in the queue at that point first crack to decide whether they want to invest. So we give more information about those particular loans, and it's up to the investor to decide whether they want to accept it or not. For each investor that gets matched to a credit event related loan, they have 24 hours to make a decision. They can choose yes to accept it, they can choose no to decline it, or if they do nothing after 24 hours, the offer lapses and it moves to the next investor in the queue at that point. Um, so we get a range of responses. Uh, the typical ratio is about a third, a third, a third. So about a third of people will often accept, a third will actively decline, and a third don't take action, which means that it lapses and nothing happens. So we still see investments sell through the secondary market that have credit investments. In fact, there's normally a small pool of them going on at any given time, and they go to the front of the investors who have orders at the front of the queue for them to make a decision. Um, Most credit event loans have typically sold within a few days. It might take up to a week, but typically inside a week and generally a few days. I can give you an idea. I saw an investor listed about a $300,000 investment that had had a credit event last week. And on about Tuesday or Wednesday, by the time we got to Saturday, most of that had been sold at that point. So, we do see investors actively taking those investments over time. Thanks for that question, Henry, and a long answer on that one. Hope that was okay. If I missed something, feel free to ask a follow-up. Follow-up question from Simon on what the interest rates are that are being earned on the reserve funds. At the moment, I think the return is running at about OCR from the bank account that they're sitting in. So currently OCR 3%. Question from Sarah. One of the emails sent out recently indicated that more loans were in the pipeline, but still took quite a long time to get invested via the term investments. At the moment, waiting times for home loan and construction loan term investments are running at between 15 and 20 days. That would be what I've observed over the last, let's say, 10 days or so. We do have loans settling all the time, so stuff's still moving. The queue's moving. It's not like there's nothing going on. So you'll definitely still see the queue moving, Sarah. My expectation is that looking at our pipeline of loans as we get towards the end of October, we see an increase in the volume of settlements kicking in. So that should mean that by that point, the length of the queue starts to shorten for people who are joining it at that point. For those that are in the queue at the moment, I'd expect that sort of 15 to 20 day period to exist. for perhaps another week before it starts to improve a little. Thanks, Sarah. Question from Joyce. So, who are the borrowers for construction loans? So, or perhaps what's the purpose of loans in our construction loan portfolio? So, typically, there's a few things. So, one, someone's buying, or a property developer or a builder is buying a section, or which could have bare land, or it could be have a single house on it, perhaps that they plan to bowl and construct new dwellings on. So that's the typical target market in there. There's the occasional less usual one, but most of it's very clearly construction related, as it says on the tin and as it should be. So most of it's that they've got to be a land and a turnkey property is about to be built. So where there's a deposit paying end buyer already identified. Um, there are spec houses being built. So that's where a builder is building with the aim to sell it during or at the end of the process. Um, and there are multi-unit developments, often in metro locations where the developers bought a piece of land. They intend going through consenting and then building 2, 3, 4 townhouses on the property. That's our typical target market for what we do in the construction space. Hopefully that answers the question there, Joyce. Thank you for that one. Question from Alan, where do you see wholesale interest rates going? They're clearly going down. I think that graph that I showed earlier for 6-month term investment rates for investors heading down to 3% from currently kind of about 3.8. That gives you a pretty clear indication of what's going on. Rates have been falling. They will bottom out at some point though. So I think over the next sort of 3 or 4 months, we'll probably reach a point where wholesale rates start to bottom, and retail rates won't be too far behind them at that point, would be my expectation. Thanks, Alan. As construction term investment is slow, is the managed funds a better option? I think I'd approach the question a slightly different way, Cherie, for that one. I would say, depending on your circumstances, term investments might suit better, or the managed fund might suit better. From a managed funds perspective, it means that you can kind of plonk your money in there, and then it's up to Squirrel to manage that and try and drive the return for you, as opposed to you making your own decisions on whether to invest in, for example, home loans or construction loans. One thing to note that for the managed fund, when you invest in there, it's up to Squirrel to manage that money. So it's joining the queue for home loans and construction loans in the same way that any other investor is. From time to time, the fund will make a decision to fund a whole loan. And so sometimes there'll be a whole loan that comes through for whatever reason that the fund also invests in. So it will take the whole loan at that point. But generally speaking, the fund joins the queue in order to get itself invested. However, you are earning the return that the fund delivers to you. At any given time, the funds have cash in them, and partly that's to manage things like progress payments that it's made commitments on, to manage investor redemptions that are going on. So yeah, the monthly income fund always has some cash floating around as well. I should also mention on that question before, Cherie, your tax position may also dictate whether it might be better to invest via the fund with the PI tax rates applying, or the resident withholding tax rates equally applying to your returns. So that tax question is one that's for each individual investor that you'll need to answer for yourself. But there can be benefits one way or the other for you. On that, Cherie, if you want to chat about that, you can book a time through the website to chat with me or Doug, and we're happy to talk you through that. Or you can always give the team a call on the 0800 number, and they can answer any simple questions that you've got around that. Thank you. Question from Joyce. So has any investor failed to get back their initial capital or return when they've invested with Squirrel? Simple answer to that one, Joyce, is no. All investors have always received their investor capital and returns back in the 10 years now, or almost 10 years that we've been lending. So Squirrel's uh, 10-year anniversary, if you like, or birthday from a lending and investment perspective kicks in November. So we're almost there for a decade of lending under our belt. So during that period, all investors have earned every cent they've expected and had every cent of capital repaid, partly because the reserve funds have done their job and acted as the buffer. Obviously, I can't predict the future though, Joyce. So, take that as you see fit. Thank you. Question from Sarah. Are we seeing any noticeable impact of government initiatives on construction and home loans? So, example, granny flats and fast track. I think the simple answer to that question, Sarah, is no. Um, you can't kickstart housing or construction in the economy overnight. It's got a 12 to 24-month lag typically from when you do something. So, from what we see in the market, in simple terms, Sarah, no. I think, as I implied during the course of the presentation, my expectation would be by the time we get to perhaps the middle of next year, I think that activity will have started to pick up in the construction space a little bit from where it is today. That's my expectation. Clearly, forward-looking statement with the usual caveats that come with it. Thanks, Sarah. Question from Alan. Why do people sell in the secondary market after a credit event rather than count on the reserve fund? I guess my observation, Alan, would be people also look to exit their investments because they want the cash back for something. So example would be you're a first home buyer, you're saving with Squirrel, you're using term investments to do that. You're getting close to looking to buy a property. So at that point, you might want to sell your investments just rather than holding to term during that period. So we see about 10 to 12 million of investor money going through the secondary market each month. So that's where an existing investor is selling an investment. Um, Most of that activity happens in construction loans, a lesser amount in home loans, and then a tiny amount in the personal loans as it stands today. So, yeah, people are wanting to get their cash back. They've tried to stay fully invested until the time they get their cash back, and then as they approach that point where they need the cash for whatever it is, they try to exit their money at that point. Um, my observation would be if you're looking to sell, allow at least a week to give you that certainty. And while you may get the cash back as it stands within 60 seconds at the moment, if you do have credit event impacted loans in your portfolio, then that can take a bit longer to sell. Typically inside a week, though. It'd be very rare for something to take longer than a week to sell. Not saying it hasn't happened, it has happened in the past, but pretty rare that that happens. The longest it's ever taken anyone to sell was during the very early days of COVID. So if you think back to March, April, May 2020, at that point, the longest it took someone to sell was about 4 weeks. Um, Although everyone who's ever listed on the secondary market has sold. So yeah, longest that we've seen it take is about 4 weeks. On average, it takes less than a day. For your own peace of mind and certainty, my recommendation is to sell at least a week in advance of when you need that cash. Obviously, for the monthly income fund, it's on a 30-day notice period when you want to make a withdrawal. Typically, we've paid out within 7 days. I don't know if we've ever had anyone wait the full 30 days to get their cash back out of the monthly income fund. So, yeah, typically it's back faster. Thanks, Alan. The question is from Jessica. Any updates on having joint investor accounts, husband and wife, and one Squirrel account? So it would be preferred outcome. We've got her on the list. It's fully designed. The development team has restarted work on that after getting pulled off to do some other bits and pieces. My expectation is that we will have that in place probably by sort of June, July next year. Obviously, that's still a long way away, and a lot can change between now and then, but that's the expectation. We've got a major update for investors, which will probably land March, April, which enables all sorts of cool new features. And then as soon as that's done, we'll be moving on to things like joint accounts, accounts for kids, um, a range of other things for entities that are investing with us. So yeah, a whole range of things are planned and on that roadmap. Thanks, Jessica. So question from Terry, when making a home or construction loan term investment, how do you know the term it will be for? So Terry, one of the harder things for Squirrel is that we won't be able to show you that term. Um, you do know the maximum term for a home loan term investment is 7 years. I think we've only ever written one or two loans for that length of time. Everything else has been 5 years or less. The average term for a home loan term investment is 2 years. Um, Typically, we don't write anything over about 3 years. There's a very odd one that's been done at 5 years, and as I said, one or two that have been done out at 7 years. Uh, Key thing there is you've got the secondary market, though, that will give you the option to sell your investment along the way. While Squirrel doesn't guarantee that you can sell it, to date, everything has sold, as I mentioned earlier. For construction loans, maximum loan term is 2 years. The average is very clearly around 12 months. So, yeah, those loan terms tend to be a bit shorter in that construction space, often reflecting either a consenting process that someone's going through or reflecting the time it takes to build a new home or a number of townhouses. Thanks, Terry. Question from Matt. Is there a way to set up an automatic payment directly into the managed fund? The answer to that today, Matt, is no. We have planned for that, and that's part of the build that will take place between now and, let's say, April next year. That's a feature that we're planning for. So we appreciate that that's something that customers want. So we'll be aiming to deliver that. It's all designed, development is commenced, but it's a pretty big build and will take us through till, I don't know, around about April, I think, before we delivering it. We'll give you plenty of warning about that one though, Matt. So, yep, that's on the drawing board and under active development now. Question from Steve. Why can we not see each queue at the start of setting up a new order in order to aid our selection? There's a good question, Steve. That's something that we can look into. I'll have a chat with the team to see if we can make that information more visible for you. I appreciate that the queues have got a bit longer just in the last wee while, and that's off the back of less loans settling. So I expect by the time we get to the end of October, those queues will have come back a little bit from the length that they are now, but they won't be back to zero, I wouldn't anticipate. So Steve, thanks for the suggestion. I'll see what we can do on that front. Thank you. Question from Peter. What's meant by softer settlement? So that's less loans that Squirrel is settling, which is less investments available for investors. So softer settlements is less loans settling from a Squirrel perspective. That's what it means. Thanks, Peter. Hopefully I've answered that one for you. Any follow-up questions, don't be afraid to chuck them in. Next one from Jeff. How much competitive pressure is there on developer lending interest rates from the finance companies that are part of the Reserve Bank Depositor Guarantee Scheme? For those finance companies, so non-bank deposit takers, we see some impact in the construction sector, but not all of them participate or don't participate fully. They might participate, for example, more so during the consenting process that a developer goes through rather than the actual build and construction process. But there is definitely signs of pressure coming through. So we're seeing some pretty competitive rates out there. It's not only those from the finance companies or the non-bank deposit takers with deposit compensation scheme cover. It's also other lenders who might lend either as a managed fund or have private money that they're using to lend. We're also seeing competition there. I think the fact that Squirrel's grown a lot has also absorbed some of that market, which has meant there's a number of lenders that have seen less deal flow than what they might have expected or might have hoped for. All of which puts downward pressure on interest rates on the borrower side. And we've all got to try and maintain a margin along the way. So you see pressure then come through on the depositor side. All right, thanks, Jeff. Really good question. Happy to take a follow-up if there was something I didn't quite answer there for you. Question from James on how the monthly income fund works compared to the term investments. I'll try and summarize this into a handful of points for you, James. So first of all, the monthly income fund is a managed fund. The term investments are term investments. The managed fund is taxed under the PI tax system. The term investments are taxed under the resident withholding tax system. So the different tax treatment makes it different for some investors. Uh, the easy example here is for those earning more than 78,000 a year, that means you'll be paying 33% resident withholding tax, and chances are you'll be paying 28% PI tax on that in that situation. So on an after-tax basis, chances are there's a benefit to investing via the monthly income fund, provided you're comfortable with the risk profile that it has, which is about 25% home loans and 75% construction loans. Okay, so if you want to decide your own mix of how you invest, then the monthly income fund might not be right. But certainly from a tax perspective, that can make a difference for investors. So your returns on an after-tax basis, which is obviously what you end up with in the hand. The way you exit your investments is a bit different between term investments and the managed fund. So the managed fund has a 30-day notice period. Typically, we've paid out faster than that, but the official feature is 30 days. So most investors will have experienced 7 days or less to get the cash out of the managed fund at this point. Versus the term investments where you sell your term investment to exit it early. That's an easy process. You literally tick a box online and we manage the sale process for you. Over the last 12 months, typically it's taken less than a day to sell, or certainly on average. There might be the odd situation where it's taken an investor longer, perhaps up to a week. And if I look back over Squirrel's history, the longest it's ever taken for someone to sell is about 4 weeks, and that was right when COVID started. So if you think back to the sort of March, April, May period 2020, every investment that listed did sell, but it was taking longer through that period, and there was all the uncertainty that was around in the world at that point, James. So what else have we got? We talked about different tax treatment. We talked about how you get your money out. How you put your money in is slightly different. So you place an investment order for the term investments and you join the queue. When you invest in the fund, you simply place the order. The money goes into the fund over the next couple of business days, and then you're invested. It's up to Squirrel then to manage getting that cash invested. And it does so most of the time simply by joining the queue that any other investor would join for term investments. The fund from time to time will fund a whole loan, so it has the right and ability to do that, but it doesn't jump the queue, so to speak, or have any privileges relative to anyone else investing via the retail term investments. All right, so those are the main differences, I think, James. Happy to take any follow-up questions if there are anything specific that you wanted answered. A question from Steve: do you plan to move away from the traditional personal investment fund? I'm going to take that question, Steve, as you're talking about personal loan term investments. If I haven't got that right, feel free to ask a follow-up. What we see for our personal loan term investments at the moment, lots of investor demand, very hard to originate high quality personal loans in the market over the last couple of years. We're determined not to drop our lending standards, so we'd rather investors had to wait rather than us write loans of lower quality. We are reviewing that portfolio, and there is every chance that we may end up pulling out of that personal loan market in due course. As I said, no decisions have been made, but we are reviewing it at the moment. Next question: would you ever close investments to new investors until the queue shortens? In simple terms, the answer is no. For our investors, you can kind of see how long the investment queue is, so you can kind of make a decision as to whether you do want to invest or not. So I don't see us closing the queue, so to speak. It's up to investors to decide whether they want to join it. Our, I guess, challenge is to make sure we continue to grow the volume of loans that we're settling. So we've got lots of plans in place on the lending side to continue to do that. and continue to ramp up our lending to quality borrowers. Really important, that last statement around quality. We do not want to, we could probably go out and lend lots more money, but they may not be as higher quality loans as what we're offering. And I don't think that's in anyone's interests, investors or squirrels, to do that. Question from Jeff. Can see total lending is growing nicely, presuming some good economies of scale for Squirrel. Thoughts on reducing the margin that Squirrel charges to help keep the returns to investors flowing with interest rates falling? Jeff, that's something we always keep an eye on. We aim to be competitive in the market, both on what we offer investors and what we offer borrowers. We also need to be cognizant of making sure we reserve appropriately. So my job, or part of my job, is to make sure we find that balance successfully. From an investor perspective, one of the things that we aim to do is deliver a return that's 1.5% to 2% higher than a bank 1-year term deposit rate. So that's one of the anchor points that we have. Right now, if you go have a look at what banks are offering for a 1-year term investment rate, you'll see that rate's probably around 350. You might find the odd one that hasn't quite dropped rates yet, or something like that. So we're higher than usual, but we can't live there forever. As I've indicated during the course of the presentation, I expect our rates will come down, so that we can continue to lend appropriately and continue to source quality loans in the market, and equally to make sure that we're still delivering what we believe is a strong value proposition for our investors. So yeah, Squirrel's margin we always keep an eye on that. If anything, that margin has been slowly coming back a little bit, based on what I've observed in recent times, certainly for construction loans. Thanks for your question, Jeff. Question from Peter. What's the managed fund management fee expressed as a percentage? The answer to that, Peter, is 2%. I think the easiest way to think about that is, if you take the borrower, what the borrower is paying, and then what the managed fund is paying, that difference, broadly speaking, is the fee. So that fee is made up of Squirrel's margin, which on average across everything that we do is about 1.65%, plus it costs us about 0.25% to run the managed fund. So we add that in, all up, plus some other admin costs there, takes us to about 2% for the fund. Yeah, so that is what it is. We think on a after fees and before tax basis, that return for the fund, which is currently running, if I look at last month, at around about 6%, we think that's pretty strong return in the market, and particularly given the high tax treatment, can deliver some pretty good returns for investors. Interestingly, across we have a range of funds. There's the retail fund, which most of you will be able to see, and underlying that, there are wholesale funds. Collectively, those funds have reached over 200 million and have about the same amount in them as the term investments by themselves now. How do you manage concentration of risk with developers? How do you prevent too much lending in one geographic area? All right, I think two separate questions there. Let's start with geographic. So Squirrel actually has a pretty good geographic mix of lending. If I look at our construction portfolio, about 45% of it is in Auckland, which feels roughly right for the proportion of population and housing density, etc. Around 25% is in the South Island. Most of that would be Canterbury, Queenstown, a little bit in Otago, and a little bit, funnily enough, in Invercargill, which actually has a pretty strong housing market at the moment, which most people won't necessarily have realised. So we have a bit of lending down, all the way down in Invercargill as well. And then the remainder, so what are we up to there? How's my math? 30% is spread mostly Tauranga, Hamilton, and Wellington. There's a little bit in other centres, so a little bit in Hawke's Bay, for example, but there's a pretty good geographic mix. We do try to keep most of our lending in main centres. For obvious reasons, it means if something goes wrong, it's going to be much easier to sell those properties. We don't really want to be building in the middle of nowhere. We don't think that's necessarily prudent for you, our investors, to be doing that. So we do try to stick to metros and larger population bases. Second question is concentration of individual developers. So we do have some developers where we have multiple loans to. Our credit policy ensures that we don't overlend to those particular developers. So very clear concentration risk management through our credit policy. Going from memory here, the maximum we have out to any one particular developer might be close to 15 million, give or take. So that would be, there might be one in that space. There might be a couple around 10 million. The rest of them are smaller than that. I'm going from memory there, Jeff, but that gives you a sense of it. So it is something we think about. We look pretty carefully at that. And occasionally we turn a loan down because it might be to one of the developers in the portfolio we already have quite a bit of lending to. So we're quite careful to try and manage that closely as we go, Jeff. Equally, we make sure that every deal that we do is secured by the property that's underneath it. So we're not cash flow lending and not lending to a group without necessarily having strong security in place. So very much property based and asset lens is what we focus on, Jeff. All right, trying to think if there's any other risk elements in your question. Geographic risk, concentration risk, type of property would be the other one. So we try to make sure we've got a mix of single house builds, 3 to 4 townhouse developments. There might be other odd one that's slightly bigger, but we try not to get into that too big a space. We try and stay smaller. We prefer the diversity offered by lots of small loans rather than lending big lumps on one particular development, which has a lot more risk than we feel comfortable offering up to our retail investors. Okay, at this stage, that's the last question in the queue. Thank you for your time. Thank you for investing with us. We're open and transparent in what we do. Happy for you to ask follow-up questions if you like directly to me at dave@squirrel.co.nz. I answer all those questions myself. And yeah, you'll be getting it from the horse's mouth. Thanks, team. Catch you later.